Good morning. We're going to be talking about Chapter 17 and 18 from Trading Price Action Trends. Here's a references slide, and it's going to be available for download in the Discord. So Chapter 17 is about horizontal lines, swing points, and other key price levels. So when Al talks about swing points, he's talking about usually a previous higher low or lower high, and he's really talking about major highs and lows. So a major high, a major high or low, right, is a high low that led to a higher high, and a major lower high is a lower high that led to a lower low. And they form across previous swing highs or lows. Most days are trading ranges, so you expect the breakouts to fail. If you're unfamiliar with it, there's an 80-20 rule that Al talks about, how on trading range days, 80% of breakouts fail, 20% of them are successful. And on trend days, 80% of breakouts succeed and 20% breakouts fail. If the first breakout is successful and a subsequent second breakout occurs, it is an even better signal to fade. So what are you talking about? So since most days are trading range days, and second entries usually have better probability, he considers a subsequent second breakout on a trading range day to be a second entry. On trend days, these lines often set up great pullback entries, and I have an example of a trading range day and a trend day in the E-mini. So you have a horizontal line, bar 1, put in the high of day here, and then bar 22 breaks it, but it's a bad breakout. It's even a bear bar, so it's a bad bull breakout. So it's a reasonable fade, double top with 22, bar 1, reasonable fade, and you were rewarded greatly. Same chart, and the prior low is set by bar 5, and I usually take the first 30 minutes of trading, for me, like an opening trading range, if you will. And conversely, you have a breakout 14 and 15, but bad follow through 16, and it's a reasonable fade as well because 15 goes outside up. And eventually the bears are able to break out, and even though the breakout here isn't very good, this buy above 38 actually never triggered, but that's neither here nor there. Moving on. This is the example I was giving about selling, or I was going to give about selling or buying above prior swing points in a trend day. So we can see market is very clearly bearish from the open. You have 4 bear bars in a row. There's one spike, but not climactic behavior, just a spike. And the bulls managed to find a bottom within the first 30 minutes of trading. And they actually ends up forming kind of like a bear flag. So, you go up, you down, up. So 3 pushes up. You could draw a wedge here. And that third push usually will give you a pretty decent sell signal. But even in this case, it's okay to sell, as you'll find out later in this presentation. It's okay to sell below the prior low of day in a strong bear trend, which is what we ended up having. Even if you don't want to sell one stop below, you can wait for the retest. And 36, 37, close enough, and it's a double top sell signal. Moving on to Chapter 18, How to Trade a Trend, Examples. I won't insult your intelligence. You can definitely pause the video here and read it yourself. But what I have coming up are just pictures of recent days, just going back about a week and a half, since we've had a lot of trend days lately in the E-mini, bull and bear trend days, but mostly bear. So that first 2 where he talks about buying a high 2 pullback to the moving average and their respective trends, this is just an example of that. So here we have a bull breakout, and we are above the moving average, so typically you're always in long. You're probably waiting for a pullback. You could have bought 28, but if you're looking specifically for a high 2 buy signal bar, after the bar 28, we break out again from bar 7 highs, which was the previous high, and you have okay follow through, and down on 36, so it's a pullback. A high 1 signal bar that actually never triggered, pullback, and then you have a high 2 signal bar 40, and your entry bar would be one tick above. And it's also the pullback to the moving average in a bull trend. And reminder that OWL uses the 20-day EMA. Conversely, for the low 2 sell signal bar, in this case it's bar 38, clearly bearish from the open, and we have a pullback. So bar 31 it starts the pullback, so the next bear bar, usually the next bear bar will be your low 1 entry, which is 30. It's actually in this case going to be 32 and not 33, since 33 goes below 32. But it's a bad low 1 sell signal because it's a bull bar. Sometimes that can work, but probably also reasonable to expect 2 legs sideways to up, because I can see a wedge. But again, you're waiting for a low 2 sell signal bar, or low 2 sell signal at the moving average, and after the second push up, you get a low 2 bar 38, and your entry bar is actually bar 40, because bar 39 doesn't go below 38, but that is your low 2 sell signal. So you can put your sell short, sell stop entry 1 tick below bar 38. For the next one, he talks about buying wedges and flags. So you have a wedge here of bar 16, 17, and 20. Essentially, a wedge is usually just 3 pushes up, and you can buy the breakout 1 tick above bar 24, or you can buy the retest, maybe on a limit order with, I think your entry is going to be bar 23 here because you're buying 1 tick above 14. And then for the bear flag, I thought that this was the clearest example that I could get. You have a wedge here. It's 2 pushes, bars 28 and 31, but it also ends up being a low 2 short signal at the moving average. And then here he talks about buying a high 1 pullback and a strong bull trend with a spike but not a climax. Think about climaxes, just to be clear, think about climaxes as things that happen towards the end of a trend. So like if we've been bullishly trending all day, and then you have a big bull bar, maybe bar, I don't know, call it 60. That's probably a climax. So at this stuff, the spike, 11 through 15, it happens early on in a trend, it's usually a strong buy. But here we're looking for a high 1 buy signal bar. We're going to get the signal at bar 18, and your entry bar is going to be 19. And then the low 1 sell signal bar, you have a spike down. And then bar 9 is a doji bar, and it actually goes above bar 8, so that's a pullback. 1 tick below bar 9. It's an even stronger sell since it closed on its low, so really good setup there. And then lastly, he talks about when this trend is very strong, you can buy the previous highs and sell the previous lows. Strong bull breakout. Again, it's the same chart that I've pretty much been using for the bulls. Likely a swing, but if you miss it, you can buy the prior swing high. So if you miss this, right, you miss the high 2 entry on the moving average, you don't buy the high 1, whatever, you can mark the horizontal line, bar 14 highs, and get in with bar 23, bar 24. Or I'm sorry, you can get in with bar 22 because you're buying one tick above on a stop order, bar 14. And for the bears in this chart, strong bear open. All the bars are relatively the same size. So it's steady selling and not climactic selling. And the market finds a bottom within 30 minutes, give or take. Within about 30 minutes. And if you don't want to enter on a low 2 short entry to the moving average and you're just waiting for a breakout, you could sell 1 tick below prior low of day, betting that we're probably going to go lower, and you were rewarded pretty well. And words of wisdom from Al. I think because one of my kryptonites personally is trend days. I think what he says here could be helpful, because a lot of times I find myself getting in the market in and out, in and out, in and out. Even though I try to be very patient, and I'll be uploading some live trading soon, so you can probably kind of see what I'm talking about when I say that. But sometimes you just need to wait until things are absolutely clear, and if they're not clear to you, then it's probably just best not to trade it. But yeah, and that's going to be it for chapter 17 and 18, and I'll see you guys next week.